Welcome to another episode in the Credit Analysis series. Today, we're exploring a fascinating and concerning phenomenon in the business world: zombie companies. These are businesses that are barely surviving on debt, unable to grow or thrive. They represent a significant challenge in modern finance and can have far-reaching effects on the entire economy. Understanding zombie companies is essential for anyone interested in credit analysis, investing, or business management. A zombie company is a business that earns just enough revenue to cover the interest payments on its debt, but cannot pay down the principal amount. Think of it like a person who can only afford to make minimum payments on their credit card, never reducing the actual balance. These companies generate minimal cash flow, barely enough to service their debt interest. More importantly, they're unable to reduce the debt principal or invest in growth opportunities. They're essentially trapped in a financial limbo, surviving but not truly living. Zombie companies share several distinct characteristics. First, they suffer from low profitability, where operating profits barely exceed their interest expenses. Second, they exhibit debt dependency, constantly relying on refinancing or taking out new loans just to survive. Third, there's no growth. These companies cannot invest in expansion, innovation, or improvement. Finally, they experience prolonged weakness, showing sustained financial distress over multiple years. This isn't a temporary rough patch. It's a chronic condition that defines their entire business model. Zombie companies don't appear overnight. They typically follow a predictable path. It starts with initial debt accumulation, where a company takes on significant debt during a growth phase or expansion. Then comes revenue decline, as market conditions worsen or competition increases, reducing the company's profits. At this point, the business enters interest-only survival mode, where it can only afford minimum interest payments and cannot reduce the principal. Finally, the company reaches zombie status, trapped in a debt cycle with no clear path to recovery or growth. Breaking out of this cycle becomes nearly impossible without dramatic intervention. The interest coverage ratio is the key metric used to identify zombie companies. This ratio is calculated by dividing operating income, also known as EBIT or earnings before interest and taxes, by interest expense. If the result is less than 1.0, the company is firmly in zombie territory, meaning it cannot even cover its interest payments from operations. A ratio between 1.0 and 1.5 indicates a high-risk zone, where the company is barely covering interest with minimal buffer for any unexpected challenges. Healthy companies typically maintain ratios well above 2.0. You might wonder why zombie companies don't simply go bankrupt. Several factors enable their persistence. Low interest rates play a major role, as cheap credit allows companies to refinance debt repeatedly without improving their operations. Lender protection is another factor, where banks avoid recognizing losses by extending more credit rather than forcing bankruptcy. Government support also plays a part, with bailouts and subsidies keeping failing businesses afloat to preserve jobs and avoid economic disruption. Finally, weak bankruptcy laws and lengthy legal processes delay the necessary closure of failing businesses, allowing zombies to linger for years. Zombie companies don't just hurt themselves, they damage the entire economy. They cause misallocation of capital, tying up resources in unproductive businesses instead of allowing that capital to flow to healthy, innovative firms. They create market distortion, artificially suppressing prices and profits for viable companies through unfair competition. They lead to reduced innovation, as stagnant firms crowd out dynamic startups and limit industry evolution. Most importantly, they contribute to lower productivity growth across the entire economy. When a significant portion of businesses are zombies, the overall efficiency and competitiveness of the economy suffers dramatically. Let's recap the essential points. Zombie companies survive on debt but cannot grow or invest in their future. An interest coverage ratio below 1.5 signals potential zombie status and should raise red flags for investors and creditors. Low interest rates and lender forbearance enable zombie persistence, creating an environment where these failing businesses can continue operating indefinitely. Most critically, zombie firms harm overall economic productivity and innovation, dragging down healthy businesses and limiting economic growth. Understanding zombie companies is crucial for anyone involved in credit analysis and investment decisions. By recognizing the warning signs early, investors can avoid these troubled businesses and creditors can take appropriate action before losses mount.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.